After crude oil recently witnessed this breakout to the upside, we are currently facing oil prices correcting. And so in today's video, we discuss whether this is just a small pullback that will be followed by a bullish reversal, or whether this is actually the beginning of a sustained bearish rally. And so in today's video, we discuss whether the upside or downside potential for crude oil is currently bigger. We're about to have a look at the most important macroeconomics to actually understand the underlying drivers of crude oil. And so if you like this approach of taking a look at the past cycles and learn from them, please make sure to subscribe to our channel and like the video so you don't miss future update videos, and also support us here on our channel. Thanks for your support. Now let's have a look at what happened to Brent crude oil the last few times we've seen the DXY and the XAUUSD to S&P 500 ratio actually behave like we're currently seeing it behave. You can see that we've marked the 2008 financial crisis and the 2020 corona crash here. And what you can see is that those crises have actually been preceded by a bullish development here at crude oil, a weakening dollar, and the gold prices actually strengthened relative to the S&P 500. And so we have seen that top actually here at crude oil being in, as we've seen that transition from this kind of consolidation, or rather we have seen that bullish trend here at this ratio between gold and the S&P 500. That means when gold is actually starting to outperform the S&P 500, the most important index in the USA, when this is actually starting to happen, when gold is strengthening stronger than the S&P 500, that is actually one of the biggest signs that you can have. And now, in addition to that, you always tend to see that actually coincide to a reversal here at the dollar strength. The DXY weakened before the crash, and then it strengthened after the crash happened. Obviously, because all of this liquidity, all of this credit, which the system is built up of, has collapsed. We have seen a massive deflationary crash happening, and obviously all of those sellers basically hold cash, and that obviously strengthened the dollar in result of that. And so we have seen that obviously leading to this big crash here in 2008, and similar things happened here in 2020. You can see we had this kind of consolidation in this case here. We haven't seen that inflationary boom before this corona crash. We have seen that more or less consolidation here. But we have also seen that the DXY sharply weakened and then sharply strengthened here at the crash. And we definitely have seen that as this actually, as this crash actually was over, we have seen that inflationary recovery that we've also seen here several times after the great financial crisis. And so if you now have a look at what happened to this ratio, which is probably one of the best indicators to actually spot a big crash happening, you can see we have also seen that big sharp increase here in this ratio between gold and the S&P 500. And so we're quite concerned because we're currently seeing similar things happening to this ratio. We're currently seeing similar things to what has happened before the 28 great financial crisis. We have seen that big weakening here at the DXY just in recent years. We have seen that strengthening ratio between gold and the S&P 500, which shows that we're moving towards a environment where gold seems to be a more favorable investment, or where people are just flocking into gold. We have seen that in previous years, and we're also seeing that the oil prices are currently starting to catch up. We're currently seeing, we have not seen what we've seen previous to the great financial crisis, with this massive inflationary development to the oil prices. We are seeing, in fact, a weakening trend over the last few years. But obviously, you have to keep in mind the fundamental aspects of this commodity. And you do see that in recent years, so here beginning in 2025, as the dollar actually weakened, we have seen this actually more or less go from a downward trend that we've seen here to now a kind of phase of consolidation. And so we're currently seeing quite similar things to what we've seen here previous to the 2020 crash. And especially what we're currently seeing happening to this ratio between gold and the S&P 500 is quite concerning, because there's always a reason why investors all over the world believe that gold prices are about, or gold as an asset is about to outperform the S&P 500. And in fact, that has been a major warning before the last few recessions that we've seen. And so to conclude what we're currently seeing here, we're seeing history repeat in our eyes across. We do see exactly the same procedures happening as we've seen it before the great financial crisis. And if you now have a look at the interest rates, you do see historically, if you just have a look at the history empirically, you do see that interest rate cuts actually preceded those two big recessions. You have seen that those interest rate cuts actually occurred before the crash happened to you in 2008. And you have seen that currently also happening, or you have seen it happening here in 2020, and you're currently also seeing it happening. And so that is always happening for a reason. We do believe when interest rates are beginning to cut, that is always signaling the end of the cycle. There's a reason we do see a need for interest rates being cut. We do see a need for increased liquidity to sustain the system running. And now we're also seeing the DXY weakening here, obviously due to that as well. The money supply has been increased by excessive lending, but nevertheless, we are seeing liquidity problems. And so the Fed balance sheet is obviously another indicator to actually understand what is happening to liquidity. We have seen here previous to the 2020 crash, this transition from quantitative tightening to quantitative easing. And so that essentially means we're just seeing the balance sheet being expanded again. The Fed actually purchasing assets. And so that obviously is done by newly created money, which obviously is therefore injected into the financial system, and that actually increases the money supply and leads to higher asset prices and devaluation of the dollar. That's what we've now seen to begin as well. We have seen exactly the same thing happen after the crash because it was of this deflationary nature. We have seen that actually begin. That's also one of the reasons we might just have seen that big price surge not only at metals but also at energy prices. But obviously, as liquidity is still tight, we do not really see a sustained breakout happening to those scarce commodities. Obviously, gold is and silver, those precious metals, are really scarce. Here with gold, sorry, with oil is obviously a different game. But if you now have a look at the daily chart again, you do see we have had this structural breakout. Whether this is actually the bottom here at oil, that's obviously a question that is hard to answer at this point. We can just tell you that historically we're currently seeing similar things happening to those indicators that we've just assessed, to what we've seen happening before those massive crashes that we've seen here in 2008, for example, and also in 2020. And so it is obviously quite concerning because of that. And we might just see a deflationary crash happening as well. Obviously, it can be of this nature that it will be recovered really quickly because of this liquidity injection that will obviously be made again by this balance sheet expansion here, and also with further interest rate cuts. And the to actually sustain that we're seeing this being recovered here, and also the S&P. Obviously, we're seeing currently all-time highs happening to. We have seen it happen to gold and silver. We are currently still seeing it happen to the S&P 500, and so we do believe that the next asset class, or this next niche to actually crash, might be equities. and that will probably lead to a deeper correction, and therefore we do believe that will also have impacts on oil prices. And so there is not a clear bull case in our eyes at Kronos. We do believe we can see a sustained rally, obviously due to this inflationary nature that we're currently seeing. But also you have to keep in mind the liquidity conditions are still quite tight. The liquidity that has been injected here since December with this QE policy beginning has not entered the markets yet. This usually takes around 80 days. And so we might just see, we do believe we could see a deflationary crash happen in the next few weeks and months. It seems quite likely because of the empirical evidences that we do see. But as always, that is not a absolute statement. You have to do your own research, and please, if you do have a different opinion about what is about to happen next, please also share it in the comments. If you want to discuss those topics deeply, please make sure to join our Discord server, which is also linked down below. Thanks for your support in this community. Just support us by hitting the like button and subscribe. Yeah, thanks for support. See you the next time. Bye bye.